Canada's piling on debt like never before, and the latest Equifax data shows that newer mortgages are going delinquent the fastest. That's right, the newest home buyers are already struggling. Meanwhile, credit cards, auto loans, and lines of credit are flashing red. And if this continues, Canada could be staring down a full-blown credit crisis. Let's break down what this means for you, for the housing market, and why government policy might actually be masking how bad things really are. Now, Equifax calls this section the credit divide, and it's exactly that. People with mortgages versus people without mortgages. Mortgage holders are tightening their belts and somehow keeping up, probably because they have equity in their houses. On the other side, non-mortgage households are cracking. Total consumer debt hit $2.58 trillion in Canada, but mortgage holders managed to slow their borrowing. Meanwhile, auto loans jumped up over 10% and credit card balances were up nearly 6% and installment loans were up more than 3%. Translation here, if you don't own a house, you're probably leaning on credit cards and car loans just to keep up with everyday life. And this is where the pain is starting to show in the consumer market outside of homeownership. Again, on homeownership, Canada's mortgage space is an equity-based loan environment. And so people keep pulling on their houses, using their houses as an ATM, taking some of that equity out through a HELOC or whatever format it is, maybe a private loan, and using that to square up other debt. Now, here's the scary part. Delinquency is rising fastest outside of mortgages. People usually protect the roof over their head until the very end, right? It's typically the last debt that people will go delinquent on. So what do they let slide before they stop paying their mortgage? Typically credit cards, auto loans, unsecured lines of credit. And according to the report, credit card delinquency is now 3.8%, auto loans around 1.1%, while mortgages are still around 0.22%, a very low number. But I'm of the opinion that this is an artificial stability, and I'll explain why in a sec. Now, young Canadians are getting crushed here by comparison to everyone else. The delinquency demographics chart shows that Gen Z and late millennials under 36 have a delinquency rate of 2.35%, way above older age groups, especially those older age individuals who have equity in their houses. Ontario and Alberta are really ground zero for this. The high cost of living, weak job prospects, expensive housing markets, it's created the perfect storm. People moving to Alberta actually had delinquency rates 26% higher than movers to other provinces. So migration, people trying to go to a different province to save their unaffordability woes in Ontario or BC, hasn't been this magic solution where the debt load follows you wherever you go. And if you can't figure out how to make things work better in a different province, then you're not paying down that debt and it's not solving your economic problems just because you're in a city that you thought was more affordable. Now, let's zoom in on mortgages a little bit. They put together this great chart called the Great Mortgage Standoff, and it shows balances over 1.9 trillion. New mortgage originations actually grew this year, up 15% year over year. The problem is vintage delinquency. And this is where the mortgage story gets really interesting from my perspective. Mortgages originated in the last few years, especially 2022 and 2023, are going delinquent much faster than older mortgages. So your buyers in many cases or renewers in the last couple of years are actually going delinquent the fastest. And that's because a lot of these borrowers bought or refinanced at the peak with high leverage at low rates, and they now are facing renewals that are at way higher interest rates. And this is the real mortgage cliff. This is a really solid illustration of what the mortgage cliff looks like. Now let's jump over to the canaries in the coal mine, credit cards and auto loans. Credit card delinquencies are now above pre-pandemic levels in Ontario, BC, and Alberta. Ontario is still up nearly 40% year over year. Auto loans tell the same story. Newer vintages, more recent purchases are going bad earlier, and younger buyers are driving most of the defaults. People give up the car payment or the Visa bill before they ever miss a mortgage payment, which means that when we start to see mortgage delinquencies rising, it's already late in the game. And this is where I'll get a little bit critical of something called the Canadian Mortgage Charter. It allows homeowners to extend amortization, defer payments, or get temporary relief if they're behind on a mortgage. It sounds nice in theory, right? But it's basically just kicking the can down the road as long as this credit cycle still needs to come to an end. There's no sense in extending borrowers who will never be able to service those loans. And Equifax data shows that Ontario and BC already have mortgage delinquencies at high rates. And that's with all of the policy band-aids. Without the mortgage charter, delinquencies would probably be much worse. In other words, the system is preventing natural economic Darwinism where bad debt gets flushed out. Instead, we're basically just building a bigger backlog of stress that's going to hit later or gets spread out. So this actually will prolong the bear market or the bottom or the long flat period where house prices can't recover because you have a bunch of people servicing loans that they should have failed on or gone delinquent on or given up if this policy and program didn't exist. So what does this mean for the housing market? Pretty simple. Number one, people are prioritizing housing above everything else. This is classically Canadian. Canadians will do anything to not fail to pay their mortgage. And as long as they can, they'll let the car or credit card or line of credit go first. Second, we have a wave of renewals coming. And when that payment shock hits, which we can see it hitting in that delinquency vintage chart, I'm of the opinion that even mortgages won't be safe from this rising delinquency trend that we're seeing. Third, if housing delinquencies rise meaningfully, supply is going to flood the market. As people are forced to sell, maybe they go delinquent, the bank forces them to sell, investors are dumping cash flow negative properties, there's job losses, economic stress. People start to try and shore up cash as much as they can from as many different sources as they can to make their household finances right. This is what a recession looks like. And this is a real risk in a credit crisis, potential credit crisis scenario that cascades into a housing correction. So big picture takeaway, Canada's already in a debt crunch. The Equifax numbers show it clearly. Younger Canadians, Ontario and BC, newer mortgages and credit cards are all flashing red. The only thing holding mortgages together is the Canadian Mortgage Charter. This is why we've seen everyone's talking about how mortgage delinquencies are so low. It's because banks have to make extreme concessions for delinquent borrowers if the borrower goes to put their house up for sale or ask for an amortization extension or some sort of accommodation. That gets taken off the books as a mortgage in arrears. They want to be protective of that 90-day arrears number because if you see a whole bunch of rising arrears for a bank that you're invested in, you're not going to be happy about that. And this artificially pulls those numbers down. And if that dam breaks, which it could, housing could be next. So if you found this breakdown helpful, please hit like, subscribe, and share this video. And let me know in the comments, do you think the Canadian Mortgage Charter is helping Canadians, or do you think it's just delaying the inevitable and getting rid of a natural economic process that we desperately need in Canada's market?